when the bank looks to give someone money, there are 5 C's of credit. There are 5 things they're going to look at before they can give someone money. The first one is character of the person. In the character, there are a few different things they will look at. The first one would be educational background. So some professionals, for example, doctors, dentists, lawyers, they have a really easy time getting a mortgage because of their educational background. The bank knows they will find a job, right? It's not that difficult to find a job as a doctor, for example, right? So that they will place high value on that. They don't have the educational background, but they have the experience. So let's say somebody has been a plumber for the last 20 years, or they have been a carpenter for the last 20 years, or they have been a truck driver for the last 20 years. So they have a lot of experience in their field. So the bank will value that as well. Or somebody who has been with their current employer for a long time. So let's say somebody's been working for the same employer for 10 or 15 years. In this case, the chances are they're going to stay with their employer, right? Because they've stayed with them this long, chances of them having a stable job are quite high, right? Okay, so or current residence. So sorry, the bank will place basically somebody who has their own house is looked upon favorably by the bank because they have been making mortgage payments all this time. So the bank will take that into consideration because if they've been making mortgage payments now, chances are they will continue to make mortgage payments over time, right? So all those things they will look at, that's character. So that's one thing that the bank will look at. Second one will be capital. Capital is the amount of down payment somebody has, right? So capital is how much money somebody has to put down. The higher the amount of money somebody puts down, the better it is from the bank's perspective. Capacity, this is important as well. Capacity is basically, is the person, how much income do they have that can go towards paying the mortgage? There are 2 things that will come into play here, TDS and GDS ratios. GDS ratio is basically your housing cost, called gross debt service ratio. So this is your housing cost. They will take a look at PITH, so principal, interest, property taxes, and heating costs. All those will go into the GDS ratio. TDS, or total debt service ratio, is basically your housing cost plus any other debt. So let's say somebody has a loan, car loan, somebody has student loan, they have other payments, those will be added as well. Okay, collateral. Collateral is basically the house itself, the property that the person is buying. Lender will take a look at the property as well. They want appraisal on the property. If there is a home inspection, they would want that. So basically, the bank is not going to give money or lend money against the property that doesn't have the value in it, right? So something that is almost a tear down. They won't be able to basically, they want a property they can market and sell easily in order to recover their money, right? So that's why they look at that. That's your collateral. Credit, they will look at credit score as well. Credit score can be between 300 to 900. And few things will come into play in the credit score. So payment history is a big part of it. 35% of the credit score will be derived from the payment history. And then 30% of the credit score is from the current level of debt. If somebody has their credit cards maxed out, all the debt instruments maxed out, their credit score is going to drop. If somebody has missed payments, their credit score is going to drop. Okay? So length of credit history is 15%. That's why it's somebody who is new to the country or they're really young, they don't have the credit history, right? So that's why their score tends to be a little bit lower. Number of credit inquiries. So if somebody is going around and asking for a lot of different people for loans, they're going to from bank to bank, asking for loans or credit lines of credit, that will have a negative impact every time there's a hard inquiry. So somebody checks the credit score, it will drop by 10 points. So that will have an impact on the credit score as well. And then the type of credit, secured credit is sorry, secured credit is better than unsecured credit. So secured credit is when there's something that is held as security. So that one will not drop the credit score as much. Okay, but overall, all these things will be looked at when they calculate the credit score.
So that's it for today. I hope you enjoyed this video. If you would like some extra help in preparing for your exam, I invite you to visit our website at www.albertarealestateschool.com, or you can give us a call at 587-936-7779. Have a wonderful day, and I'll see you next time.